And we have Jason Wendel here with us from the Salt Lake office. He has 19 years of experience in public and private sectors, and he's directed offices, the foreign offices, domestic offices, work with management, and they are here to talk about the new revenue standard implementation. So we're excited to have them. I'll turn the time over to them.
All right. Well, thank you. We're glad to be here. When I graduated from Utah State back in 1998, which for a lot of you that makes me feel like that was a long time ago, but there's a handful of you that makes me feel like it was just yesterday. So that's kind of good to have a good mixture here. But when I graduated and went out and started in public accounting, there wasn't a lot of great guidance as it related to revenue recognition. In fact, from a general perspective, most companies used the SEC SABs as it relates to determining how to recognize revenue. And as I got a little bit more experience in different industries, I came to understand that it seemed like pretty much every industry had their own accounting literatures that related to revenue. And there wasn't one place where you could go and find out what the revenue recognition standard is. You just had to keep going to different places. And so it was a lot of confusion. It was pretty challenging for clients as well as for the auditors to try and figure out sometimes what's the right answer, what's the standard that should be used as far as recognizing revenue. And I was thinking about that today, and it reminds me of a situation where I had a client where they did a lot of training, and they had been hired to go get some training, but they were also going to develop some videos to go along with their training. And I was reading their memo as it related to how they were going to recognize this revenue, because it was going to be, all these things are going to be delivered over a period of time. And they started referring to this gap reference, which I'd never heard of before. So I went and I looked it up, and it related to revenue recognition for the motion picture distribution industry. And so I had a few interesting conversations with the controller as to how in the world he felt that he could be using film industry revenue recognition guidance to come up with their training materials and so forth. And so you could see there's a lot of challenges out there. And so this kind of kicked off, and I don't even remember the exact year, but it was mid to early 2000s when the FASB and its counterpart, the ISB, started to work on a convergence process of different topics, and revenue was one of them. And so they got started on that, and the result of that is a new standard that's just come out a couple years ago, ASC 606. And so we're going to kind of go through and give some high level as to how this new revenue recognition standard will work. And so basically it comes down to there's a five-step process that companies will now go through in order to determine the amount and the timing of the revenue that will get recognized. And so one of the chief objectives was to try and come up with a framework that would work for everybody, although that's difficult to do with the various industries that are out there. But nevertheless, this was their best effort. It took nearly 10 years to get it to come out, but they finally got it out. But as they were coming out, they knew there were some issues that they still had to deal with. So anyways, we'll walk through these 5 parts, and I'll have Ryan help out on some of this as well. But you can kind of see those different steps that need to be taken. Obviously the first is you need to make sure you've got a contract. Then you got to define, okay, what are my obligations? What am I required to perform? What's the service or the products? And then determining what's the transaction price. And then from there, I've got to allocate that transaction price to the different components if there's multiple pieces. And then the last step is the timing on when it gets recognized. So like I said, when it first kind of came out, and they finally got it out after hundreds of comments from academics, from companies, from accounting firms, They knew it wasn't perfect, and so subsequent to it coming out, they've issued these other auditing standard updates that amend that initial ASU that came out. So the first one, and the most one that people love, was the 1-year deferral. That was kind of like the first one that came out. Once people saw the full thing, there was quite a bit of uproar, and so there's a lot of pressure on the FASB to extend the timing for which this new standard is going to be effective. So with the deferral date now, public companies are required, calendar year public companies are required to adopt this new standard effective in 2018. Private companies have till 2019. So still a couple years away for a lot of private companies, but publics, it's not that far down the road. So the next ASU that came out, 2016-10, kind of spoke to some of the issues that are out there as it relates to revenue recognition on licenses. And then also, sales-based performance, usage and royalties. Again, there's further clarification on helping individuals understand how to identify what a performance obligation is, so some clarifications there. And then the next one that came out is just kind of a principal versus agent considerations that hadn't been fully vetted and given some feedback that had been received by the FASB through various topic teams. They determined that they needed to clarify the principal versus agent guidance that was in there. ASU 2016-12 came out, and that just kind of addresses a couple specific one-off things as it relates to sales taxes, how to deal with collectability as it relates to the performance conditions and the collection of that estimated purchase price or sales price. And then also there was a lot of feedback on companies wanting help as to how they would implement certain things and how certain industries were going to have issues as it related to adopting this. And so the FASB came out with certain practical expedients to make it a little bit easier for companies to adopt the new standard. And then there's some stuff on completed contracts. So those have all come out, but there's also currently an exposure draft on a couple other things related to the disclosures that are required, and then just some general technical corrections. On the far right-hand side of the slide, you can see that the ISB, they came out with theirs as well about the same time, and they've come out and clarified a few things in theirs. So the objective was to try and have the FASB and the ISB come together and have a converged standard on revenue recognition. And they got close, and now they're starting to come apart. So there are some differences, but for the most part, they're much more converged than what they were in the past. So with that, let me turn it over to Ryan. He's going to walk through those 5 steps and explain how those work.
All right. So good afternoon. As Marcus said, I'm from the Portland office. I didn't spend my whole career there. I spent 3 years at our national office in New York. While there, I spent a decent amount of time following the new revenue standard. And when Jason asked me to come and help present, I have to say, he put in his email, and I know you were thinking that, this is how important we think you are, Ryan. But he said, hey, we were thinking about getting Lynn Doty, who is our CEO, but she had a conflict. And I was thinking, how many people in between Lynn Doty and Ryan Marquez there must have been that you called before you got to me?
It was 1,800.
Right. Then he said we have 50 minutes to cover the new revenue standard. And I said, well, we'll do our best. So we're going to try and give you a good overview of these principles. So we threw out our guidance. We now have principles. I've been given these trainings now for almost 2 years, and I've watched the audience go through what I would say is like the 10 stages of denial or of grief. So we started with denial 2 years ago when I was presenting. Even the KPMG managers and partners said, this isn't going to happen, right? There's no way this is going to happen. We're not going to get rid of our guidance. And I said, yeah, it's going to happen. And then there was anger with the 1-year deferral. It was originally proposed as a 2-year deferral, and everyone was upset that they didn't get the 2 years. We only got 1-year deferral. And now finally, when I'm giving these presentations, people are engaged. They're like, all right, I know this is coming. I'm going to have to listen. So I think we're there. And if we're talking about the principles, you have to remember that this is very different from the guidance that we have today. So today, as Jason mentioned, we have very specific rules-based literature that is a lot of times specific to certain industries. Now we're going to principles. And the overarching principle is that you recognize revenue as you transfer control based on the amount you expect to receive from your customer. And they give us 5 steps. So the first step is we have to decide, does a contract exist? And the boards, the FASB gave 5 indicators. Those are up here on the slide. So some of these will sound kind of familiar if you're at all familiar with SAB 104, which is typically what you would use to recognize revenue today. So the rights to the goods and services, the rights and obligations have to be identifiable. It has to be approved. It has to have commercial substance, and collection of the consideration has to be probable. So that is a change from the wording that exists today. Today, the wording is that collectability has to be reasonably assured. And this is just like the first example of where you're taking a rules-based standard, ASC 605, where there's a word that is different. Collectability is reasonably assured is definitely different than collectability is probable. And companies are left having to decide, well, does that change any of my conclusions? And that'll be the common theme that you'll hear me kind of bring up throughout this presentation, because that's really what the users and preparers of the financial statements are struggling with. What do these principles mean when I actually go to implement it? The FASB purposely put collectability in step 1 as a gating item. So this is a gating criteria to get into the model. And why does that matter? Well, it matters because if I can't get into the model, so if I can't conclude that collectability is probable, then I can't recognize revenue. And I've got to go down and another path and follow some other guidance on what to do when I'm not in the model. So there's been a lot of questions and back and forth on what that means. And in short, the takeaway has been you're going to assess collectability on what you expect to receive. So there's a lot of fact patterns where, for example, in the healthcare industry, the question was, well, if I have someone come into the emergency room and I administer services, do I assess collectability on that 100%, the total list price of whatever those services are? Because if I was to assess collectability on that, I might conclude that collectability is not probable. And the feedback or the clarification that you mentioned earlier that came out in one of those exposure drafts is that you really look at what you expect to receive, and if in that case you expect to receive 10%, 15%, that's the amount that you would assess collectability on. Now, there's probably smart people out there that are going, well, there's 5 steps. I saw that one of the steps was determine the transaction price. We're at step 1. How am I going to assess collectability if I haven't even got to step 3 where I'm supposed to determine the transaction price? And in a lot of cases, you're going to have to fast forward to step 3, come up with the transaction price, then you can move back to step 1 in order to assess the collectability. So that's step 1. Step 2. And I will say step 1 and step 2 are really where most of the confusion around this new standard exists. And if there's any questions, feel free to raise your hand. Step 2. After we've decided we're in the model, we meet the 4 or the 5 criteria, now we have to determine what are our performance obligations. Another word, new term. Today we would say those are deliverables. FASB gave it a new term, performance obligations, and gave it a new definition. So they said a performance obligation exists if it is both capable of being distinct, and distinct within the context of the contract. Two more new terms. If we conclude that it's both capable of being distinct and distinct within the context of the contract, we are going to allocate revenue to that performance obligation. So let's talk about these two criteria. What does it mean to be capable of being distinct? And I'm going to use an example of a home builder. The FASB gave some criteria that said something is capable of being distinct if the customer can use it on its own or in combination with other goods or services, if it can be sold for more than scrap value, and if it's sold on a standalone basis, then it's capable of being distinct. So if I'm talking about a home builder, just about everything is capable of being distinct. It's a pretty low hurdle. 2x4, the fridge, the shingles, all those are sold on a standalone basis. They are all capable of being distinct. So then would you say you have many performance obligations? Only unless you concluded that it was also distinct within the context of the contract. Now what that means, the FASB again gave 3 criteria, said that something is distinct within the context of the contract if there are no integration efforts or services performed on those. Clearly that's not the case with our 2x4s, shingles, flooring, all being integrated into one unit. If it's not significantly modifying or affecting another good or service. And lastly, if it's not highly interrelated or highly interdependent. If you said that it was both capable of being distinct and distinct within the context of the contract, then you would say it's a separate performance obligation. So if I'm looking at all of the things that go into building a house, clearly they're all highly interrelated, they're all highly interdependent, they're all modifying each other, there's significant integration work. So I would conclude, if I'm a home builder, that I just have one performance obligation. That's a really easy example. There's a lot of more complicated examples. About, I guess it was probably only a year and a half ago, the classic example was printer and a printer cartridge. Would we say those are one performance obligation or two? And in a room like this of a lot of people that like to nerd out on the revenue standard, they said how many said it's two and how many said it's one, and it was 50-50 split. So one of the revisions that they came out with was supposed to help people think through what it means to be highly interrelated and highly interdependent, because I think I could make a pretty good argument that the printer and the printer cartridge are highly interrelated. And while they gave some new words and they kind of tried to expand the guidance, really the only thing that helped is they put the exact printer cartridge example in the new standard. So now we have that, and it's two separate performance obligations. Any questions on performance obligations? Because this is probably the area where there's been the most confusion. And I'll bring up one additional kind of point of clarity. In the new standard, there was in the basis for conclusion, it actually said that the concept of inconsequential or perfunctory no longer exists. So in current GAAP, there's an SEC speech that says to the extent that a deliverable is inconsequential or perfunctory, we don't account for those. So if you have a coffee cup that you give for free when you sell the car, you don't have to defer revenue or try and allocate revenue to that coffee cup. Clearly that's inconsequential or perfunctory. So then the new standard says, well, that doesn't exist. Nobody liked that. All of these, you pick any widget producer that had, there was examples like, hey, I have a 1-800 number on the back of my tube of toothpaste. Does that mean that I need to, that's a service that I'm providing, do I need to say that's a separate performance obligation and allocate revenue to that service? Because if you read the original standard, you could easily come to that conclusion if this whole concept of inconsequential and perfunctory didn't exist. FASB said, we don't want all the widget producers to have to now do multiple element arrangements and allocate revenue to their 1-800 numbers. So we're going to put in this concept of immaterial in the context of the contract. So that to the extent that there are goods or services that you're giving, a good example is a 1-800 number or the free coffee mug that comes with the car. Clearly that's immaterial in the context of the contract. You do not have to account for those as a performance obligation, even if they meet these two conditions. Now they gave us that makes a lot of sense, but did they give us any help or guidance on what it means to be immaterial in the context of the contract? No. So we're kind of left with it's qualitative and quantitative factors that we would consider. Any questions? Great. So then we go to step 3. We have to determine the transaction price. And here you can see right in the middle we had collectability with big X on it. That's because we're not assessing collectability here when we're determining the transaction price. Remember, we did that back in step 1 because that was the gating item to get into the model. When we determine the transaction price, there's 4 different types of transactions prices that we would need to look at for guidance. There's a variable consideration. There's the financing component. So to the extent that I'm either getting payment or I'm giving credit for up to more than a year, then I have to account for that financing component. There's non-cash considerations. That'd be if I receive some good or service as opposed to receiving cash. And then the last would be consideration payable to a customer. The overarching concept here is where in SAB 104 and in most revenue arrangements today, we would say that the price needs to be fixed and determinable. That concept no longer exists. The FASB and the ISB thinks that all the accountants out there are pretty smart and they know what their revenue is going to be. So they're telling us to estimate. So there's going to be a lot more judgment and there's going to be a lot more estimation that goes into revenue recognition. And to the extent that a company was deferring revenue because something wasn't fixed or determinable, they'll no longer be deferring that revenue, and now they'll need to estimate that revenue. So if anything, the takeaway is that revenue probably is going to be recognized sooner than it is today. Okay, so once we've decided we're in the model, we figured out what all our performance obligations are, and now we've determined what the transaction price is. Next, we need to take that transaction price and allocate it to all of our performance obligations. And we have a really nice flow chart here to help you understand how you might do that. I would say this isn't that helpful other than to tell you that you're going to allocate some revenue to all those performance obligations one way or another. Today, there's concepts like VSOE that must exist in order to allocate revenue. That's in the software industry. There's other areas where, like I mentioned, if it's not fixed and determinable, I may decide I can't allocate. Again, the FASB thinks all the accountants are smart enough that using one of these methods, they give you the best method, which is observable price. They're on left. But if you don't have observable price, then you're going to use some other method, potentially an adjusted market approach, maybe an expected cost plus a margin. And even if all those don't work, there are going to be some cases where you could use a residual approach. So you will take your transaction price and allocate it to all of those separate performance obligations. Once you've done that, then we get to step 5. Now we can finally recognize and book a journal entry. And before we book a journal entry, we have to decide, am I going to recognize this revenue at a point in time or over time? And the FASB clearly stated that you will first step through the overtime criteria to see if you qualify for any of those, and that is a privilege that you have to step through these criteria. If you meet any of these criteria, then you will be recognizing revenue over time as control is transferred. If you don't, then you would conclude that you're going to recognize revenue at a point in time. This is another area where there's some probably significant differences out in certain industries. So if any of these three criteria are met, you're going to recognize revenue over time. The first one is that the customer simultaneously receives and consumes the benefits as the entity performs. So think of like a cable contract. The TV is always there. For the whole month that you're paying for, you're receiving that and consuming it as it's being provided. Not a lot of change there. Those companies were probably recognizing revenue over that service period to begin with. The next one is that the customer controls the asset as the entity creates or enhances it. So this is like the home builder. I have a piece of land. The home builder's building a house for me. Clearly, I'm controlling that asset as it's being created. That home builder, therefore, meets this criteria, so they're going to recognize revenue over time. Probably not a lot of change there for construction companies. Last one is where we've seen a lot of change. So if the entity's performance, and I don't like the way it's worded in the negative, but if we are creating an asset with no alternative use, and we have right to payment for our partial performance, then we are concluding that, or the new standard is telling us, you're going to recognize revenue over time. So an example, if I'm a contract manufacturer for Apple and Foxconn, and Apple says you are contractually not allowed to use these parts for anything else, and typically the contracts, those contract manufacturers have in them provisions that say, whatever I've built, I have a right to payment for that. And a lot of times there's even a right to payment for their raw materials and WIP. If those provisions exist, then that contract manufacturer that used to recognize revenue every time they shipped a good to Apple, now is recognizing revenue over time. So what does that mean? Well, that means every time they build a unit, they're probably going to be recognizing revenue because they are, in essence, the new standard would say they're transferring control of that asset to Apple. And then it goes on. There's additional guidance on how you would measure your progress to date, but that's a big change. And the contract manufacturing industry I think they've got to acceptance, but they had to move through all 10 stages before they got to acceptance. But that will be a big change. If you meet any one of those three, you're going to recognize revenue over time. If you don't, then you go to the point-in-time indicators. And the point-in-time indicators, the next slide, would be these 5. Present obligation to pay, physical possession, legal title, risk and rewards of ownership, and then acceptance. Now today, under SAB 104, which is probably what most companies that would get to concluding you're recognizing revenue point in time, they would say that delivery has to have occurred, and that's the criteria, and that's a real risk and loss notion. Here, physical possession and legal title are 2 of the criteria, but there are 5. There's others, a right to pay or obligation to pay, the risks and rewards, and acceptance of the asset. So while you might be in a situation where you're concluding that the point in time you recognize revenue is the same under ASC 606, the new guidance, versus ASC 605, you clearly have different indicators, different words that you'd have to step through in order to make that conclusion. Any questions on those points? Okay. So I would love to tell you that it was as easy as just those 5 steps and that we just gave you, or the FASB gave you, the method, this principle and the 5 steps, and then you're done. Unfortunately, that's not the case. There is specific guidance over all of these They call them implementation considerations. Each one of these could be a course in and of itself, but just know that once you've gone through the 5 steps, you're probably going to, it's likely that you'll have to go to one of these specific topics if you have something like licensing of IP, for example.
So you might think, well, 5 steps, that's not too big of a change. I can do that, right? And you might be thinking, well, I don't think this is going to have a big impact on my company, but the fact of the matter is it is. And the main reason that we can see here the objectives of the new revenue recognition standard is, like discussed earlier, just to kind of bring it all together, which I think for the most part, the FASB's done a pretty good job of it. That prior slide that had all those issues, those are being embedded within the same standard. So now instead of having 140 some odd different pieces of revenue recognition literature out there, it's now all kind of been jammed into one big one with a fairly broad framework that is going to require a lot more judgment, as Ryan explained. So as we kind of go through and look and say, okay, has the FASB accomplished their objectives? I think the first one, yeah, they've been able to bring it into one main piece of literature. And for the most part, they've been able to remove some inconsistencies between different industries as it relates to revenue recognition, and hopefully will provide a little bit more consistency between companies. But again, with the removal of some of the specificity for certain industries, it's going to allow for a little bit more judgment by companies and how they apply some of this, walk through those 5 steps. So again, they've provided a robust framework. Then we kind of drop down to these 2 boxes down below. Now the one was to provide more useful information through improved disclosure requirements. How many of us seen a set of financial statements under IFRS? Anybody? Nobody? Nobody's seen any IFRS financial statements. They're about 2 to 3 times larger than GAAP financial statements due to the disclosure requirements. And the main reason for that is because companies have more judgment as to how they apply the standards. They have to provide more information to give that information as to what those judgments are, and so that companies or individuals can take that information and compare it to, say, some other company that may have applied or used a different practical expedient. And so there's more information that's going to be in there, which then, as I look at the bottom right-hand corner, simplify the preparation of financial statements. I don't think we're going to get there when it comes to GAAP. Maybe for IFRS it's a little bit more simplified, but I think for US GAAP, we will see our financial statement disclosures over revenue significantly more robust than what we have in the past. So it'll be interesting to see how these things play out in practice, but the big concern was, well, what's the cost as it relates to adopting this new standard? And here are just some of the quotes that came out from different companies, whether it's the Wall Street Journal or Emerson's letter to the FASB. But basically, everyone's acknowledging that this is going to have potentially a significant change on their systems, their people, their processes, and their controls. And for a lot of industries where there was that specific guidance out there, they're going to start seeing more revenue recognized earlier than they would have in the past. Because I think there was a bias in the FASB where in the past, if there's any significant indecision as to maybe what the revenue amount should be that's recognized, let's just defer. We'll defer till the end or to a later point in time. Now this is becoming a little bit more objective as to when the timing of that revenue should be recorded, and so it's going to result in a little bit more revenue being recorded earlier. The industries that, off the top of my head, that will probably see some of the biggest impacts were those in real estate, those companies with software, companies that do multiple element arrangements, multiple deliverables, or performance conditions is the new term now. Construction companies also will see significant changes. So those are all types of things that we have to keep in mind And even if you're a products company that just sells a product and ships it to somebody, there's still some implications that you're going to have to walk through that may be a little bit different. So you may come to the same answer, but the road that you've got to get through and the controls that you have to have in place are going to change. So a couple things as you're thinking through this. We've kind of divided up into basically 3 different phases as to how you would analyze and start getting prepared. And if you haven't started phase 1, you're behind. If you're not in the design phase, you're probably behind, especially if you're a public company. But phase 1 is basically to understand what the new standard is. How does this new standard relate to the revenue streams that you have as a company? And then compare that to what you've currently got to kind of identify where the differences are. So that once you understand those differences, you can then go to the design phase to figure out what do I need to do to change in order to be able to walk through this 5-step process to be able to make sure that I'm recording the right revenue at the right time for the right deliverables. And then obviously the phase 3, which is usually the most important and most difficult one, is being able to implement that when people are already busy with their normal jobs. There's resource constraints on trying to figure out, who's going to do what. But that's also a very difficult one, and you want to make sure that you have enough time to get through that. So here's a slide that just provides different revenue software programs that are out there. We're not saying any of these are better than any of the other ones that are out there, but this just kind of gives you some idea of different software providers out there that are developing software that will provide some of the abilities that you're going to need to be able to recognize revenue in the case that you need to change your software. So I'm going to hand it back over to Ryan to go through some of the examples that are fairly standard that you would experience to see what some of those changes would be.
Yeah, and can I see this? We're running short, so I think I'm going to pick my favorite one first. So as Jason mentioned, you start with phase 1, which is the assess phase. Typically, that's where most of the work is in a company. And the reason that's the case is because you're taking all of your current contracts, current revenue streams, and you're saying, where are my gaps? What are the differences? And then once you've identified the gaps and the differences, you've got to take and put together something that might look like this to address what's the old standard say, what does the new standard say, and now what's my kind of policy or impact going to be. I think a lot of cases that might be that there is no change and that we can continue to account for things the way we've been accounting for them today. But we just don't know that until we've done that kind of first phase 1 assessment. So we thought it might be helpful to put, we put 4 different gaps is what we call them. Gaps between 605 and 606 that I think would exist in just about any company. And then we'll start and go through this one and see how we're doing on time after that. So warranties is a specific service that companies provide. And if we went back to step 2 and talked about performance obligations and those 2 criteria, clearly a warranty, whether it's just a standard warranty or an extended warranty, it meets both of those. It's capable of being distinct, and it's distinct within the context of the contract. And there's new guidance in the revenue standard that would tell you originally that just about every warranty would have been a separate performance obligation. Now today, a standard warranty that's not sold separately is revenue is not deferred. It's got separate guidance. Revenue is not deferred for that warranty, and we just treat the cost as a fulfillment cost that we accrue when we sell the good or service. Today, or under 606, you'll have to go through new criteria that would help you understand whether your warranty is an assurance type warranty or a service type warranty. And the assurance warranty is something that only warranties against specs, or that it's basically it's doing what you said it was going to do. But if there's any service, and it gives some indicators on when you might conclude that your warranty is a service type warranty, then you're going to have to call that a separate performance obligation. And remember, when you call it a separate performance obligation, we have to take some of that transaction price and allocate it to that warranty. And then to the extent that it meets the overtime criteria, which I would tell you it almost always would meet the overtime criteria, we would recognize that revenue over the term of that warranty contract. So what's an example? An example is if I'm a luggage producer and I give a lifetime warranty, today those companies, for the most part, I think, say that's just my standard warranty. I'm not going to defer any revenue for a lifetime warranty on my luggage. One of the indicators in the new standard that you're providing a service is the amount of time that you're providing that service. And the longer the time period, the more likely that there is something there that you're providing. So if I'm providing a lifetime warranty, you're going to have a really hard time arguing that that's not a separate performance obligation. So all those luggage manufacturers out there are going to have to either change their lifetime warranties, or now they'll have to start deferring some revenue and estimating how long that lifetime warranty typically lasts. So just an example, I think in most cases you're probably going to conclude that you have the same accounting that you have today, but we're just having different words and new words that'll help us, that get us there. I think I'd love to go through all of them, but I don't know that we have.
Ryan really likes this stuff.
Yeah, right.
So, but we'll. But given the lack of time, I don't know that we've got much time for questions. But as far as resources go, if you need a cure for insomnia, you can go to this website. We've got our manual. I think it's like 500 pages. It'll help you walk through examples and so forth. But the key takeaway is this is a big change. Don't take it lightly, and get engaged quickly with those either above you or below you to make sure that you're addressing this, because it's a big change. And then right after this one, we've got the new lease standard that's coming in play that's going to result in major impacts on your balance sheet by grossing up your balance sheets for even your operating leases and so forth. So a lot of changes coming down in the accounting, on our accounting statements in the next 3 to 4 years. So with that, appreciate your time, and good luck with the new standard.